Hello to everybody. This is the coach from winningstockcoach.com. Gonna speak a little bit about our market overview for the upcoming week. I'm sure that you've listened to the news and, you know, over the past year you listen to the news and as the red candle's made, what do you hear? Oh my lord, the run is over, the run is over. Scares you into selling, only to find out later that 2 days afterwards they're going, big bull run is coming. The news is very hard to believe. That's the plain and simple. The news is hard to believe. Having an idea of how these things work yourself is going to be essential to your trading and essential to your livelihood. So we're going to go over market overview for the upcoming week beginning January 27, 2014, which is also a big earnings week. A lot of tech companies, a lot of big stocks going to be reporting earnings, which those alone could get a little bit of a swing in the market. Also, Wednesday, very important day, the Fed's due to announce either a continuation or no continuation to the withdrawal of quantitative easing, also known as QE, in that dreaded word taper. Also on Friday, Ben Bernanke will retire. Janet Yellen will take over. A lot of things this week that could swing the markets. So let's take a look at a couple things here that I think are going to be essential for you to understand, because understanding what's going on prevents you from having to fear what's going on. What does that mean? Well, if you have an understanding of what's going on, you have an understanding of where your safe levels of support are in the market and such, what you're going to find is that you will not necessarily have to be scared into selling, or you'll know exactly where to sell. So, today I'm doing this, which is something I normally put out to subscribers of the coaches roster, which can be found at winnings.coach.com. It's one of the services and chat room services that's offered. But I wanted to put this out publicly because I truly believe that at least having an idea of key points that you should look at is something that everybody should know, whether they are a subscriber to winnings.coach.com and the coaches roster, whether they're doing this on their own and trying to make it in the markets. You need to know what's going on, what to look for, what signals will actually tell you to sell, and what signals may tell you to get ready for the next run. Let's face it, for the past year and a half, all we've heard on the news is accumulating numbers of bears, or whatever you want to label them as, instilling fear of how this run is too heavy to sustain, and I come across people all the time and they make the sell only to see new highs being made. So we can't discredit the possibility of a new high being made. We can't discredit it. But we need to understand what lies before us technically and fundamentally that could shape the markets in the coming days, week, and really over the coming month of February, for a few different reasons. Now, the chart you're going to see in front of you, you might be looking at and say, okay, he's running radar or doing whatever he's doing. There's a lot of technical tools that I use in my charting, and I've become quite accurate in their usage, and it's helped me be quite successful in my trading. It's helped my members be quite successful in their trading. So what we're looking at here, this is a 20-year weekly chart of the SPX, the S&P 500. Many times I'll ask people, name the market crashes that you're familiar with. And they tell me the Great Depression, the Great Recession. They tend to forget about several others. And on this 20-year chart, you can see a couple. Here, we have a common area known as the tech bubble. Here, we have that Great Recession, or i.e. the housing bubble. And over the years, we've had several. Now, the key point to kind of look at here is the amount of time between 1995 in 2000, when the markets went from a low to high point. Also, from October of 2002 into October of 2007, when the markets went from their low to their high point. If you noticed already, you got a 5-year period here. You've got a 5-year period here, almost to the day. And here, we have just shy of a 5-year period that could lead us into that first week of March, really. So, do I think there's a chance that we could get a support level bounce on the S&P 500 and maybe make one last hoorah, one last high? Well, of course there's always the chance. But do I think the fundamental changes that are taking place in the markets could sway it other way? Well, that's a very high possibility too. Well, what fundamental changes are taking place in our markets? Well, let's understand that we've been leaning on a crutch, per se, with quantitative easing. We've allowed our markets to become overinflated, trading well beyond valuation points. And this crutch is beginning to be removed. The crutch is beginning to shorten, creating a fundamental change in the markets. You know, I've seen different news-related stories and stuff, and they're telling me that, you know, we're having a mixed earnings season. I've read a lot of earnings reports. I follow a lot of stocks. In my most humble opinion, the earnings season has not been great at all. As a matter of fact, the past few quarters have not been great at all, regardless of what numbers companies are putting up. They're shaving costs. They're shaving future investment in themselves. They're shaving jobs. They're shaving things to make the numbers look good. In this past week, I saw an alarming number of filings for company executives selling shares. Thought that was a little bit ironic for companies that are just doing so well. We saw the best run in the S&P 500 this past year since 1997. Well, you know, in 1998 it continued up for half the year before kind of retesting those 1997 highs and running again. So could it be kind of a mixed market year? Well, who knows? Who knows? But identifying the key points technically in relation to fundamental changes taking place can better assist you in knowing when the best time to exit or enter a trade. And that's what we're going to talk about here. So, you know, I'm going to shorten this chart down here. You know, you are looking at the 20-year weekly of the S&P 500. I wanted to point out the 5-year correlation in our time frames here. I also want to point out this dashed red line here. You know, because this is going to come into play a little later in this video as a potential support point. So I want you to be able to see that. And also I want you to kind of look at this 1885-86. What this is to me, it really seems to be about as much as this thing would be able to squeeze out of it. Now you may take that as, well, you know, then there's a good chance that the risk now outweighs the reward. I could potentially try to hold for a fall only to squeeze a wee little bit more out. Or I could be happy with what I've already gained and take the profits before having to feel any sense of danger in the markets. So I'm going to go ahead and look here on a daily chart for the SPX, and we're going to see some shorter terms. This is a 1-year daily chart. We're going to see a little bit shorter term evaluation type on what we have ahead. Now, I can tell you that there's a couple support points here that alarmed me to identify to members of mine on Thursday, creating a really good day for us on Friday, believe it or not. There were things that, we exited. It might even have been a small loss, but they kept going down a lot farther. And we did this because we identified a support level failure since the government shut down, and through that no taper day where most people thought the markets would tank then, and they shot up to make new record highs. In this support point, the trend line it was trading on was failed. Well, on that failure, the support level failure, we were able to determine that our best interest was to the short side of the market, and we capitalized on many trades in that manner in just a single day. Now, this particular blue trend line you see coming across my chart, this is a potential support point that could be met, but I have one problem with this. Even though I don't put a lot of value into the futures when it comes to how they trade between the market hours, they can come into play as the market prepares to open. And the futures on Friday traded down below 1780. Well, if they traded down below 1780, and we continue to do so, this trend line here will not be looking to hold. Now, I had some of the best trades of my life in 2013 coming off this trend line. And to make this easy, I'm going to change the color on the trend line here, and we'll just go with a nice blue color. And the reason we're going to go with this is I want you to see some great opportunities that were made, and very fast opportunities. Options traders were loving these times off of this blue trend line. And where we were getting steady pullbacks before, come November, when the market needed to pull back to replicate the patterns it had already been making, it didn't give us the pullback. So we went from these big strong runs that had pullbacks, because the fact of how charts work is the harder you run up, the harder you'll pull back, and the more you pull back, the more strength you have for the next run. And because we never got a significant pullback, what we found was shorter up moves, shorter down moves, shorter up moves, shorter down moves. A very confusing time in the markets overall over the past couple months. It was almost as if you were going 3 steps forward, 2 steps back, 3 steps forward, 2 steps back. I say that because you still continued to make higher lows and higher highs throughout the process. Now, this nice pretty blue line, this trend line that you can see, yes, it failed. At the time, many people believed this was a manufactured crisis. You might look at this chart and say, well, I don't know what manufactured crisis you're talking about. And that's our government shutdown, the U.S. government shutdown. This was a time where stocks lost support temporarily, causing people to panic and sell out because, hey, we didn't know what was going on. And in the 11th hour, the heroes, our elected officials, came through. They decided not to continue in the shutdown. They weren't going to default on debt, and the markets rallied. Well, that also created another possible trend line. Now, in the event that we get into Monday, we need to watch for the key values set by these first 2 trend lines. The first will be in that price range of about, we'll say 1785, give or take a little bit, 1786. And should you get another hard fall, 1760s, 1761, 1762 as potential support points. Now, is there a possibility that the market just bounces from right here? There's always that possibility. But let's look at some of the consistencies over the last year in the market. The best year since 1997. Stocks don't go straight up. And even though this isn't exactly a stock, this chart is determined by a conglomerate made up of the S&P 500. And we look at these things because most charts will follow an indice chart very, very closely. So knowing that you could have made money at different times buying, well, heck, you could say I could have bought any time in 2013 and made money, and I could say that's very true. But you can find that the likelihood, the best buys came really around this blue trend line. But as that trend line failed during the government shutdown, and people, you know, the algorithms and everything we trade against, this war we have on Wall Street, the average Joe investor that's trying to make it, may not look back at these things and say, oh yeah, the government shut down, ignore it. So we have to understand some other possibilities. Now, of course, with 2 big down days, everybody and their brother that wants their name on the news crawls out and says, you know, this is the correction, you know, this is where it's all going to fail. Well, understand a couple terms. When you hear the word correction, that's really a term to instill fear in you. In reality, every time the market pulled back to this very trend line I'm talking about, you were in no danger whatsoever. So is there a chance that the high has been made? Is there a chance that the bears are right? Of course, that chance always exists. But is there a chance that long-term positions may be better off still to allow this support to see if it fails, so that you aren't one of the many that was scared out of their stocks in August when the media covered how bad this taper could be and blah blah blah, and then we get no taper, we get big up day, only to get devastated by the thoughts of the government shutdown and fallen, and you sell your shares only to see, crap, it's going up again. Sometimes as a trader and an investor, you have to be educated on the likelihood of something. When it comes to terms like support and resistance that are commonly used in terminology for traders, you have to assume that support will hold until it's broken. You have to assume that resistance will not be broken until it is. Because if you set your sights too high, you may never see your target. And if you set your sights too low, you may never see your opportunity while only seeing the price rise above you. So we have a couple key things in line for the S&P 500 in this coming week. First and foremost, does it hold the line? Does it hold this darker blue line? Does it hold in that value in the high 1780s? Or does it fail? And if it fails, does it hold in those low 1760s? Now I want to point out another thing on the intensity of this fall. The intensity of this fall hasn't been seen since June of 2013. Very similar fall percentage-wise, and though it slowed shortly after, you did continue to have a little bit of downside. So is it possible to get a little bit of downside as the move slows? Absolutely, it's possible. In fact, when you're driving 60 miles an hour down the interstate and you push the brake, you don't stop instantly. A train running down the track does not stop instantly. And the stock market can be like that too at times. How are you safe? Or never safe, but safer? How do you manage your risk? Make sure you're buying on a positive move from support. And on the positive move from support, you use the support level in your exit strategy. Why? Because you also have to assume that once support is broken, you're headed to the next support level. There's only a couple possible trend lines to fail here before we get to that red dashed line that marked those two tops from the tech bubble and the housing bubble. That in all reality, should we return down to this area, we can still say that our markets recovered from the Great Recession, because we will have returned to the value they were holding at prior to. And what could that do for your stock? Well, some stocks will have things come about that still make them go up or down, regardless of the movement of the S&P 500. But most stocks will replicate the move. So understand where your support levels are. Understand options, not as necessarily contracts that people speak of as options, but the options you have to reduce position size to limit risk, leverage long positions by the use of options contracts, the puts, or to simply sell because you may think that the potential top is not worth the risk. So overall, as far as the view of the S&P 500, it'd be very easy for me to make a prediction, and if I'm right, I could launch a whole lot of these videos and look, I was right. That's simply not in my nature. What I'm going to say might sound like a bit of a cop-out. We need to see where we start on Monday. If we make support level bounces and are looking for that buy opportunity on Monday or Tuesday, we may need to enter those a tad bit smaller than normal in lieu of receiving the Fed notes on Wednesday, because that indeed could create another fundamental change in our market. We have to mitigate our risk through planned position sizing. Let's face it, when it comes to Wall Street, nobody cares about your money but you. And if you're going to recklessly trade your money, you won't be hanging around Wall Street very, very long. Now I'm going to switch over to a chart. This is the SPY. This is the Spider S&P 500 Trust. It's a tradable version. As far as our charts go, we get a reading of volume. The reading of volume that correlate with the S&P 500. And you'll notice, as we got into these bumps without a pullback, our volume pretty well decreased. Gave us a couple spikes, when the taper news came out. But many times, price follows volume. And we had a whole lot of volume to the downside on Thursday and Friday of this past week. Now, we had a whole lot of volume, almost a replicating volume pattern, back to that time I referenced in June. And though we still had a couple more down days, the brakes were already being ridden. The volume on the sell-off had decreased, but the best time to buy wasn't the day after the biggest fall. To be aware of these things is going to benefit you, because it's going to give you an understanding of how your stocks may be affected, how entries you've been planning may not hold. It's not an effort to scare you out of buying. It's an effort to educate you of the risk, but also to educate you of the reward. As I said earlier, that one blue trend line, which is a different color blue on this chart for me, but a potential bounce target where every time in 2013 that I made entries off of this line, I had exceptional trade entries. It could still very well do that. but it has not yet. It has not yet. We need to use our volume to assist us in determining when that change in direction may happen. And it'll help us in planning our entries or planning our exits. Up next, we're going to talk about the Dow Jones Industrial Average. Most brokers, you can be able to view this chart by typing in $DJI. Similar to the S&P 500, we see a supporting trend line being lost on Thursday of this past week, with a large down day created on Friday, and no noticeable bounce level of support for quite a ways down. Now, where does this line come from when you see only 1 point here? I'll go to the weekly chart. I'm just going to go to a 5-year weekly, and we can put many trend lines on it from this point. We can run from the low after that crisis in 2008, and we can actually start to see a little bit of a more clear channel being made. Now, when other pullbacks were made here, it didn't pull back all the way to this line. In fact, we've only got a couple points thus far that have hit this line. But by adding something as simple as a trend line to our charts will allow us to see if the current directions are still being held. Why did you get big volume sell-offs beginning on Thursday? Your price lost the trend. And the assumption was made that we could very well be heading here. So we might as well sell before we get there. It's a plain and simple theory there. I'm at a higher price here than I will be here. Therefore, I can sell and simply buy again on a bounce. And as that trickles through the markets and more people notice, the more selling takes place. Now, the loss seen in the last couple days on the Dow, quite intense, but also very closely replicating moves seen in June. Replicating moves that didn't come down to a trend line before making another decent move. So is that a possibility as well? Well, let me tell you where that possibility comes in. When this down move was made, and you look at the low from a pullback that took place before an uptrend, the low that was made here never exceeded the low that was made there. So if we were going to plan for entries based on that possibility, we cannot exceed a value on the Dow Jones Industrial Average lower than 15,703.79. And we could still have that higher low anticipation and confirmation to buy, with giving us a stop based on that type of entry of the low price that we've marked, and not allowing ourselves to fall below it so that we can minimize our risk. A lot of people don't like to think of actually having to sell something, but selling something can prevent you from a lot of heartache. And that's something we have to understand at this point in time. Now, much like the way the SPY will follow the S&P 500 in a tradable ETF fashion, the DIA ticker symbol DIA, has that same relation to the Dow Jones Industrial Average. Again, we see that the critical support level failed. We see the possibility that we could still make a higher low while having trendline support down in this area on this stock of about $154.20. That's still a little ways from your current price. It will be very, very important to once again confirm based on Monday, and maybe even caution a little bit into the Fed minutes being released on Wednesday to dictate any major entries. Now here I'm showing the IWM, which has that same relation that the SPY and the DIA have to indices, to the Russell 2000, our small cap index. Man, small caps have really been on a tear. I'm showing you a 10-year weekly chart here, and what we see on this weekly chart is a common chart pattern known as the cup and handle. You can see that you get a bit of a cup looking pattern here with a handle before breaking out of this resistance line, this top level that had been noted and pulled back from on more than one occasion, and then the breakout with momentum from it. Now, how do these cup and handle trades typically play out? Well, as you can see, they don't always pull back right away. And in fact, until the IWM were to fail this trend line up here, it's in no real danger. But the reality of the technical evaluation of a cup and handle trade is that though you might not know how long it can continue to break out from, it nearly always returns to the breakout point. It nearly always returns to the breakout point. So let's move over to the Russell 2000 chart, the RUT, and let's look at what that could mean. Should trend lines be failed, and you can see trend lines I've got marked for various reasons, and I'll shorten my chart in a moment. And should this first trend line be failed, well, you'd assume that it's going to hit the next one. Should that fail, you'd assume it's going to hit the next one. And should that fail, you would assume that the Russell 2000 could make a pretty lengthy pullback to retest the multiple top, the cup and handle breakout, whatever you may want to call this, and to retest that as the majority of cup and handle technical trades will do. What does that mean for small caps? Well, in reality, it means that small caps could be due for the biggest hits. But if you understand what you're looking at here, you could also view that as an understanding of some great, phenomenal entry opportunities, just by simply recognizing the move as it's made. So let's shorten this down. We'll go to first a 5-year weekly, and we'll see the trend lines based on different things, and they actually come, if you look at my 1-year daily chart, you'll see that the trend changes that were made, and when a higher low was made, you know, I've got this bottom trend line, a much longer term trend line than the others, but the others have held up nonetheless. And we begin to look at a support level of 1132.50 or so, you know, between 1132 1134 area. And in reality, long-term positions, the ones you've invested in properly, they are in no danger until the point where this has failed. But if this line fails, well, you could have quite the hit down to the next one and not very much room to the next one. And by the time that third one fails, if it ever does, you see I got to scrunch my chart really, really small here. And may have to just put it back on the weekly. So that you can see that should our trend lines fail, though no stock goes straight up, straight down, you would have probably steady lower low, lower high as it bounces and trickles its way down, just in the same nature it made its way up. That if these support levels begin to fail, you may be looking at the high from a price well below it. I know myself personally, I've decided that most of my small caps have run phenomenally already. Could I maybe hold on and make a little more profit off of them? Absolutely. But am I already more than impressed with the profit they saw? Absolutely. In my own risk to reward analysis, I decided to leverage some of my larger cap stocks via put options and severely reduce, if not completely sell out, of my small cap trades. Should the support levels hold, should we get the bounce that many people may think we could get, I will not be afraid to rebuy. But I may just still simply think that I've already squeezed a great deal out of these. And greed, rather than a recognition of reality, is what hurts most traders and investors. So, as you watch these things over the coming days, I hope that you take a moment to view some of these very, very simple tools. Yeah, I could have elaborated. I could have given you the Harvard version that you may not have understood. But I wanted to give you a version that you could easily replicate in what you yourself are viewing, so that you could protect yourself, so that you could understand there's still some safety until point X. And if point X fails, I need to make a decision, but I need to make that decision based on the reality. I need to look at these things in a manner of what they are doing and not what I want them to do. I need to be neither a bull or a bear, but somebody who simply takes it as I see it. As a trader and investor, you constantly have to be evolving because the markets are constantly evolving around you. Failure to do so will result in failure. So I wish you all the best of luck in the upcoming week. I'm in high hopes that we get our support level bounces. I'm a natural bull. I hope we get support level bounces that lead to phenomenal trading and not the consolidation moves that we saw through November and December and January. It's healthy to have a pullback in the market. It doesn't mean it's the end of the world. But where does that line stop? And that line stops in the areas that I've discussed with you on 3 major charts here. So I hope you watch the video. I hope you play the video again. I hope you play the video again. I hope you play the video again. And I hope you realize that by no means is this intended to scare anybody out of the markets, to scare anybody out of a trade. It's simply being provided because there's too many people on those news channels you watch. that are scaring you out repeatedly over the past 1 to 2 years, when in fact it turns out to be the best time to buy. Now, I don't know that that's what this will be, but I know how to recognize it. And I know how to tell subscribers to winningstockcoach.com how to recognize it. And I know how to trade in association with it. And I know that when the time comes to make a decision, my experience will allow me to make the proper one. So, again, critical levels of support ahead of us in the indices. Those supports fail, as we saw shorter term supports fail on Thursday, and a high level of selling could occur and could carry us to the next level of support. Take the time to evaluate your comfort level in a trade before it is happening. Sit down tonight and look at long positions you're holding and say, what point am I willing to allow this to pull back to before I'm no longer happy? And create a plan that you are willing to execute should the opportunity present itself. And also have a plan for price levels you wish to purchase a stock should the support levels hold. Because for the last year, year and a half, I've heard in a cycle of every other month, every Joe Schmo on television, the quote-unquote experts, telling me to sell when indeed it was the best time to buy. So could they be right this time? Could it be the time to sell? You don't know until you're looking at the bottom from the top. And you also don't know that that was the top until you're looking at it from well below it. And that's why we have to make well-informed decisions based on proper risk management and not the greed that persists throughout our markets. This is the coach from winningstockcoach.com. Wish everybody the best of luck in their trading and in the upcoming week especially. Understand your key support levels. Understand what they mean. Understand the no need to panic until they're tested and failed. And still no need to panic. Just a need to make a decision. God bless and best of luck.